respected traders, investors, and friends. My name is Nenad, also known as Tarantula, and I'm here to introduce you to the father of modern candlestick charting, Japanese candlesticks, Mr. Steve Nison. Before we begin, please be aware of the risks associated with forex trading, because trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. By accepting the risk disclaimer, you're proceeding further with us. My name is Nenad, and I provide the real-life trading webinars and education with Admiral Markets. And for all of you who don't know me, this year I have won the award for the best podcast and took the second place among the best analysts on forex3.com. Working together with Mr. Chris Warzik, we ensure that all our webinars are top quality and dedicated to you, traders. You can always come, and we invite you to our live trading webinars that are easily accessed by registering on Admiral Markets website. But this is not about us today, because we have a special guest here, a living legend among traders, Mr. Steve Nison. So being a professional trader, educator, and analyst, it's an honor to work with Steve together, and I'm sure that you will learn a lot today. In my opinion, candlestick charting is an absolute must-know, and that is the easiest way to compare historical versus now moment buyers and sellers, and that is the easiest way to do by using Japanese candlesticks. So Mr. Steve Nison is known worldwide as the father of modern candlestick charting. He's not only introduced this exciting and powerful charting method to Western traders, but also he continues training thousands of traders and investors every year. So Steve is really a living legend in the trading world. Today, Steve considers himself more an educator than technical analyst, but he still follows market closely. And some traders say that technical analysis is just a telltale of voodoo. But guys, both you and I know it's not, because we always show our results on live webinars, and results speak more than words. So another thing that we will have today is some presents for you. Steve was very eager to share 3 subscriptions to randomly selected traders. So we will have a raffle by a random walk for 3 monthly subscription to MT4 candle highlighter included in the package by the end of the webinar, so stay tuned. And now is the time for Steve. I wish Steve a big welcome so we can start.
Great, thank you so much. It's such a pleasure being here. And let me just show my screen. Here we go, and let's make sure we are good. There we go. Great. Okay, thank you so much for giving me this opportunity to speak to so many of your students and potential students. And thanks so much for the wonderful introduction. And you're going to see it's this session, this special session I prepared for Admiral Markets, is more than just candlesticks. And you'll see why I'm saying that in a little bit. But just to give you a little overview, for those of you who are new to candlesticks, let me give you some of the benefits which you'll discover by the end of the seminar. First of all, candlesticks are very easy to understand. All right, you'll be amazed with how easy they are to construct. I know many of you are familiar already with the construction, but I want to emphasize, don't let how easy they are fool you, because they're extremely powerful. The main benefit of candlestick charts is you're going to be the first to get early reversals. And by the way, I will stay around, let me mention, because we're getting a lot of questions. I will stay around after the session to take your questions. So feel free to ask questions, when I'm done with my portion. Safety first. And what do we mean by safety first? We mean that the candlesticks will let you know which potential trades to avoid. Look, at the end of the day, it's not only how much you make by being correct, but how much you don't lose by being incorrect. So you're going to see candlesticks help you avoid potentially bad trades. This is really powerful. I'll be spending some time on this later in the seminar. East plus West. That means that you can combine your favorite Western charting techniques, and I'll show you some of mine, like moving averages, Fibonacci retracements, oscillators, whatever you're using now, you can still use on a candlestick chart. And then add the insights of the candlesticks, the Japanese candlesticks, that is Eastern strategies. And I'll show real-world examples in the Forex market throughout the session. And this works in all Forex markets in all time frames. Now, most of my charts are going to be, because they're MT4, are going to be mainly Forex. I know MT4 does give you the ability for those who have access to other markets. So keep in mind that candlesticks work not only in Forex markets, but in all markets and all time frames. And what's wonderful about the candlesticks is that they really let you gauge what's going on now, real time, so you could really do analysis of the markets very, very quickly. So, as I mentioned a couple of minutes ago, I will be teaching you about candlesticks, but it's much more than that. We have what we call our trading triad success system. And triad is an English word, or it's actually a Latin word, I think it's derived from Latin, meaning three, triad. And so the 3 legs, I compare it to a stool with 3 legs. You know, if you have 1 leg of a stool, you're going to fall over. If you have 2 legs of a stool, you might fall over. But 3 legs give you stability. So we're going to be looking at 3 legs of the stool here. We'll be focusing mainly on the candle charting, but first leg is candle charting techniques. The second leg, and I made reference to this a couple of minutes ago, is candlesticks plus Western indicators. And the third leg is candlesticks and trade management. Now we have such a huge number of attendees. Again, I want to congratulate you for taking the time and effort to attend the session, or for those of you watching the video, to take the time to watch the video. But some of you may be brand new to candlesticks, so I'm just going to do this very quickly, going over the basic construction of the candlestick line. The Japanese will say, without oars, you cannot cross in a boat. So I want to make sure we all have the oars. And the candlestick line is made of 4 components: open, high, low, and close. If the close is higher than the open, this is called the real body. You have a white real body. If the close is under the open, you have a black real body. Now, the high and low of the session, these are called shadows or wicks. Some of you may have a different charting. Instead of a white real body, it might be a green real body for a bullish session. Instead of a black real body, it might be a red real body. Doesn't matter. But what I wanted to highlight is, look at these data points: high, close, open, low. And this is exactly what you need on a bar chart, the old type. When I say the old type, the type of charts that they used to use in the West before I revealed candlesticks in the 1980s. It's to me, it's still amazing that before my first book came out in 1990, there was not one charting system anywhere in America or Europe that had candlesticks. They were all in bar charts. And now candlestick charts, because they are so powerful and give so many insights, are the default chart for pretty much all the financial websites and trading sites. Okay, and those are the shadows I mentioned. And this is really important. As shown on the title here, candlesticks or candles give you twice the information as a bar chart. Why? Why do I say that? Because candles, like a bar chart, will show us the price: open, high, low, and close. But this is particularly important, especially for you who trade Forex. Plus, candles reveal the force of the current move. And what does that mean to your Forex trading? How does knowing the force of the current move help you? The Japanese will say the real body is the essence of the price movement. So let me ask you, who's in charge here? The bulls or the bears? And how do we know? Remember, with a white real body, think about it, the market opened here and closed there. Right, you're all getting it. Bulls, exactly. The market opened near the lows and closed, in this case, near the highs. So you have a tall white real body. Again, on your screen, depending on, MT4, you might have this as green instead of white. And the same thing here, the black real body. Opened here, closed here. How do we know it opened here and not down here? Right, because it's a black real body, so the bears are in control. And the reason I had mentioned a couple of minutes ago the importance of gauging or using the real body to gauge the momentum of a move is because in Forex, unlike other markets, you don't have volume. See, when I use candlesticks in the equity markets or markets that have volume, we could add volume as another indicator on our chart. So we could use volume to gauge the force of the move. We don't have volume in Forex. So this is a great visual way of gauging a force behind the move. So obviously with this tall white candle, we have strong bullish momentum. Okay. So here we have a doji, and a doji in a market means the opening and closing are the same. So here we have an opening and closing. Here's the high of the session and the low of the session. And what the doji means is an equilibrium between the bulls and the bears. Okay. And by the way, it's a good point. Derez is mentioning you have volume and MT4 from the futures market. Unfortunately, futures is such a small percentage of, compared to the cash market. And I usually defer to the cash market to try to, for my candlestick charts. But good point on that for those who are looking for volume. You could get volume on futures. But getting back to this, this is telling us there's a market imbalance between the bulls and the bears. And the Japanese will say, and I've had dozens of books translated from Japanese to English, the market is at a point of indecision. Now, what does that mean to your trading? Okay, so here, who's in charge in this tall green candle that I'm highlighting with my arrow? Okay, the market opened there. Exactly, Ermi, right. And close there. The bulls are in charge. What about this session? It's a doji. The Japanese will say that with a doji, the market is tired. Now, let me give you a word of caution. A doji does not necessarily mean the market's going to go from up to down. We all are looking for the magic candlestick signals. The doji is telling us instead the market's gone from up to neutral. It doesn't mean it's going from up to down. And by that, we know the odds of a market have become greater for a reversal. But if the market, and we'll look at this a little bit later, you could use the high of the doji as resistance. If the market closes above this high here, it's actually a bullish breakout. And I'll look at a chart with that in a couple of minutes. But so it doesn't mean the market's going to go from up to down. It doesn't mean that you should be doing a bear trade here. It means maybe a time to take profits. If the market starts stalling around the doji, you could think about doing a bear trade. And one of the great things about Forex is, I'm sure you all know, it's as easy to do a bear trade, to sell short, as it is to go long. In the equity markets, at least in the States, I'm not sure how it is overseas, it's very hard to do a short trade in stocks. So, unless you do options. But here in Forex, you can take advantage of down moves. And what's great about bear moves, a lot of times they will move faster than a bull move, because fear is a much greater emotion, a stronger emotion than greed. Okay, when you see a bearish signal and the market starts turning down, you may, a lot of the traders may want to bail out so the market can move down very quickly. So here we have a doji, the market's tired. Okay, now I would also view this as a doji, although it's not a perfect doji, but let's look at it in comparison to the prior candles. Bulls are in charge, bulls are in charge. Now all of a sudden we have a relatively small real body. I would equate this, or I'd make this the same as a doji, and that would tell me that the market might be having some problems. Oops. Now this is also a doji, okay, although not a perfect doji, but this real body is so small compared to the other ones. And I also wanted to discuss this. It's a high wave candle. A high wave means it has a long lower and upper shadow. Remember, there's the lower shadow, and that's the upper shadow is the lower shadow. And what this means is that the market, the doji is telling us the market's tired, but the long upper and lower shadow is also kind of echoing that by telling us the market is confused. Because look, the market, and this could be a daily chart, a 5-minute chart, a weekly chart, it really doesn't matter. During this time period, the market rallied, but what happened by the end of the session? It had pulled back. Sometime during the session, the market sold off, but by the end of the session, it rallied to close up here. So it rallies, it sells off, it sells off, it rallies. The market does not know what it wants to do. And that's a market that is confused. And what does that mean? Was the market confused during this rally where each day we had a higher high, a higher close, a higher low? Was the market confused? Did the market know what it wanted to do? Of course, it wanted to move up. But here, the market is telling us it's having some problems now. And notice, by the way, also, we've gone from higher highs and higher lows. What was happening here? What was happening to the highs and the lows and the closes? See? Now we're in a trading range. Now, this may not be bearish, but were we in a trading range here? No, the bulls, we were in a very strong bull channel. Now, all of a sudden, the market's trading laterally in what the Japanese call a box range. So the trend has gone from up to neutral. So you would see that on a bar chart, and you can also see that on a candlestick chart. But now we have the extra insight with that doji. Okay, let me ask you, based on this, these two charts here, we'll call this chart 1 and chart 2. Which is a better doji to either short, either one, you can either short or exit. In other words, which doji would you say is more likely to have the market reverse? I mean, we know what happened after, but let's imagine we did not know what happened after this or after this. Where would you be more aggressive, let's say, on a bearish trade, and why? Okay, so we're getting some number 2s and number 1. Okay, for those of you who said 1, why would you be more confident that the market's going to reverse? Now, when I say reverse, it doesn't mean immediately. It just means, it's going to go down at some point. Okay, so because of doji. All right, so over here, because somebody's saying number 2, because the doji here at number 1 doesn't look exactly like a doji. That's true, but to me that's not important. This open and close is so close, I would view it the same pretty much as a doji. And let's see what else you're saying. Number 1, because the price came after a large trend. That's a great point. That's a good point. That's something I didn't even think of. So what he's saying, and I don't, I'm sorry, I don't want to mispronounce names. So Javier, I think, Mr. or Mrs. Diaz, I could pronounce the last name, is saying the market moved up so quickly here, it got overbought. In other words, it moved up too far, too fast, and that could be true. You could also say that for here, it moved up so quickly, it's overextended. But the answer to this is number, drum roll, please. And by the way, we're going to have some chart challenges a little bit later on. The answer is number 1. And the reason for that is What do you think? Remember I was talking about just even using traditional Western charting techniques. What is one confirming compared to number two? What do we have here? Okay, it's confirming a short-term resistance area, right? The market here is confirming the highs over here. Now, normally, you have two highs, the same, it's not a big deal, but you could see that the market is now moved from up to, remember, we don't know what happened here, but now it's confirming this prior high, so we're confirming a short-term resistance area. Is number one, based on this, is number two confirming a resistance area? No. So based on this, I would be more confident of being bearish on number one. And this, I wanted to bring this up early because it really echoes the importance of not looking at candles in isolation, all right? And we'll look at that in a couple of minutes. But one of the things to keep in mind, and I mentioned here, which is the better short or exit, candlesticks are not only great for giving you entry signals, let's say you imagine you shorted here and have a protective stop over here, but for exiting. So if you were long, this would be a great time to take some profits. If you were long here, this would be a great time to take some profits, because we all are very inclined to let our profits ride. It's just human nature. We just want to hold it a little bit more to get those profits just a little bit more, and this is what happens. How many of us have been in a trade a little bit too long only to have all our profits blown apart, right? Helene is saying, yeah, I believe every one of us. That's true. That's me today. Okay, Sally is saying that. It's true. So candles are great at letting you know when to lock in at least some of the profits. I mean, it doesn't mean you have to lock in everything. And this is what I mentioned before. I want to spend a couple of minutes on candles and context. So one of the things we bring in our education is not only candlesticks, but how to use candlesticks correctly. There's a lot of information out there on the internet. There are a lot of other services that do education on candlesticks, but remember, I was the one who revealed them to the West. I've spent 30 years with candlesticks, and what I found is a lot of these educators, a lot of this software, and I'll talk about our software in a couple of minutes, are not using candlesticks correctly. They'll see a candlestick signal, and they'll say, oh, we have a bullish signal, it's time to buy or time to sell. That is not true. So here, for example, by the way, this is one of the quotes I had from one of the Japanese books. To know where you stand is as important as candle pattern recognition. Okay, so here we have this master, and I'll wait a second or two because I see it takes a while. I guess we have so many people and we have nearly 1,000 attendees. So sometimes it takes a little bit to have the PowerPoint slideshow. Here we have the master carpenter, and you can see his apprentice obviously does not use the hammer correctly. So we're here to make sure I use the hammer, in other words, the tool of candlesticks correctly. Okay, you must learn to properly use the tools. And that's why I'm so thrilled that Academy, Admiral Markets gave me the ability to help you discover how to use candlesticks correctly for your trading. So let's look at this. All right, doji and trend. Now, the market's moving up. Is there a trend to reverse? Sure. So to me, I view this doji as a warning. And again, let me wait a minute or two to make sure there we go. Get the slide up. Now, a lateral trading range. Let's imagine we have the market moving up and down. This is resistance tested a few times over here and support tested a few times. So the doji is in the middle of a trading range. Is that doji telling us anything new about the market? No, not really, because the doji is telling us the market's undecided. It doesn't know what it wants to do. But so is the box range, right? It's a confused market. It doesn't know what it wants to do. So a doji in the middle of a box range is really not a trading signal. A doji after a rally could be viewed as a time to, take some profits or be short. And then again, with the candles in context, where would you be more aggressive if you have a doji like this or a doji confirming a resistance area? Obviously, if a doji confirms a resistance area. And so the thrust of this part of the seminar is always look at the candlesticks, but view them in the context of the overall market. Give you another example. Here we have a doji at 1 and a doji at 2. Now, let's think about these doji. And the idea here is I want to take you just beyond the basics. I want to give you a little bit more advanced information. That's why Admiral had me come here today to take you to that next level. So what's the difference between the doji at 1 and over 2 over here? And let's look at this resistance area. I'll give you a little hint. This resistance area over here. See resistance at 108.45. Okay. But here the market, the doji has closed above this short-term resistance area over here. This doji has not closed above a resistance area. And something else I want to bring out is a doji, and let me go to the next slide here, and then I'm going to come back to this one. You could use the doji as resistance. So what you do is you take the highest high of the two shadows, in other words, the candle line before the doji and the doji, whichever one has the higher high becomes resistance. So based on this becomes our resistance area. But let's say we have a doji with an upper shadow that goes to here. That then becomes our resistance. So if you are doing a bearish trade, a short trade, you should use this as resistance. Let me go back to the prior slide and show you. So even if you view this doji as bearish over here, once it closed above it, that is a bullish breakout. And that actually is a good time to do a momentum trade. In other words, trading on a breakout. And I'll show you an example of this on the next one here. So let's look at it here again. So there's that doji, and this is a resistance area. So once the market closed above resistance, that could be a momentum trade. And a lot of these candlestick signals can be used as support or resistance. And what does that mean? That means if it breaks resistance like it does here, you could view this as a momentum, a bullish breakout trade. Now notice here, this is the resistance area because you have the doji here and the high over here. So this is our resistance. You should set a protective stop if you're short at that level there. And notice how the market stalled day after day. This happens to be actually a 30-minute chart. 30-minute period after 30-minute period. Okay, and there's your breakout. Another Japanese proverb says, it takes the clap of two hands to make a sound. And believe it or not, all the insights we've gotten in this first half hour or so is just based on the real bodies. We're looking at one hand, the real body. We haven't looked at the shadows yet. A tall real body means the bulls or the bears are in charge. A doji means there's a balance between the bulls and the bears, and the market could have a reversal. But shadows are also very important. So as we saw, the longer the real body, the stronger the momentum. A white real body or a green real body means strong bullish momentum. A black real body, a long black real body means strong bearish momentum. But the relative size and position of the shadow displays the extent of the price rejection. Let me show that. Greg is saying, I hear the sound of whiskey. You probably hear the sound of ice because I'm drinking some iced coffee, actually. If you hear me start slurring my speech, that means I'm drinking whiskey. Okay, so we're going to be looking at a candlestick line that has a very long lower shadow. It's called a hammer. And the market has to be in a downtrend. We have a small real body, black or white. that is at least the lower shadow has to be twice the height of the real body. We want to see the market selling off and then bouncing back very strongly. How do we see it? How do we prove a bounce back? A very strong bounce back? By the lower shadow, show you, twice the height of the real body. And the Japanese will say it's a chance to buy at the bottom. And we could use the low of the hammer as a support area. So if you buy on the hammer and the market gets under the hammer, especially on a close, you should be out of the long position. But keep in mind, just because you have a hammer doesn't mean you necessarily should be buying on every hammer. And one of the ways you could tell if a hammer is a good potential buying opportunity or not is using this. What we've done in some of our full-day seminars is we've asked the traders, what are the biggest challenges? We all have the same challenge. And one of them was identifying if support or resistance is stronger or weaker. And if you know support is stronger, you'd be more aggressive on a long trade. If you know resistance is stronger, you'd be either more aggressive on the bear trade or more likely to get out of a long position. And likewise, if you know support is stronger, not only will you be more aggressive on buying, but you'd be more likely to get out of a bear trade, lock in some profits. And this is one of the ways, this is where the east-west confirmation comes in. And this is really, really important. Okay, this is one of the things I always look at before doing a trade. One, is there a candlestick signal? And two, does the candlestick signal confirm a Western technical signal? Does it confirm a moving average? Does it confirm a Fibonacci retracement? Does it confirm a support area? Does it confirm an oscillator you may be looking at? Now, one of my favorite Western indicators, I keep it real simple. I like looking at horizontal support or resistance. Okay, I'll look at Bollinger Bands to gauge if the market is overbought or oversold. But let me show you an example of how we could use candlesticks to confirm a Western signal. Okay, here we have a 15-minute chart, and what I try to do for this special webcast and recording is use all time frames. You'll see 5-minute, 15-minute, 30-minute, daily. I even have a weekly. The only time I really look at weekly Forex is to get a longer-term trend direction or to get major resistance. But here we have a 15-minute Euro US, and again I did all sorts of markets, crosses, and pairs. And here we have a classic hammer, and this one I like a lot. I mentioned before a hammer could have a green or red real body, right, or black or white real body. But I like when it's a green real body because that means the market closed right near its high, right? So here we have a hammer, and is it confirming support? Yes. So would we see the support area on a bar chart? And I'd probably make the support zone, probably something like this. I'd make a zone here. Let me actually, one of the great things about using PowerPoint is that I could actually do things on the fly. And let me make that a little bit thicker. Okay, let me go back to the magic of the screen here. Okay, so I'd actually make this a support zone, the lows here to lows here. So the hammer is confirming support. And what does that mean? Well, if you buy, you know where the protective stop, under the low of the hammer. I'll probably give it, a little bit of leeway. But this is what I look for when a candlestick signal confirms a Western signal. And you may have your favorite Western signals. You may look at Fibonacci retracements. You may be looking at, MACD. Whatever you use, continue using, and just add candlesticks for your final confirmation. And this is exactly what the Japanese do. When I had the books translated, I spent tens of thousands, if not hundreds of thousands of dollars getting the Japanese books translated back in the 1980s. I found an American who was going to Japan, and I told him to buy every book he could on candlesticks, and he spent a year translating them, and then I spent a year going over the translations to organize them. Then it took me about a year to write my first book. But what the Japanese do is they know all our Western charting techniques, and they use them, and they add the candlesticks for the final confirmation for their trade or investment. And a question, it's pertinent here. Normally I'll answer questions at the end, but Domian wants to know if an upper shadow is okay. Yeah, you can have a small upper shadow for a hammer. Essentially, if the upper shadow is 10% or less than the lower shadow, then it would be a hammer. And that's how we define it in our software. Tarantula will be raffling our Nison candle highlighter software in a little bit, and I'll tell you a little bit about it later on, but that's how we define a hammer in our software. Okay. Now, for every candlestick signal, there's a reversal. In other words, we had the bullish hammer over here, and the opposite of the hammer is the shooting star. Now, because candlestick signals are reversals, that means the market has to be in a short-term uptrend. The market has to be in an uptrend. And we have a white or black real body, and the upper shadow is at least 2 times the height of the real body. And why is that? Because we want to see the market, it rallied here. In this case, it opened here, it rallied to here, and it sold off to close here. So the market could not sustain the rally. Remember, the candlesticks are simplicity themselves. They're very simple to draw up, but they give you tremendous insights into who's winning the battle between the bulls and the bears. All right, and we can see by this long upper shadow that the bears, either the bears are taking over or the bulls are losing steam. Either way, it's a potential reversal. And we could use the high of the shooting star as a resistance area. Okay, so here we have a shooting star, and it's okay to have a little bit of a lower shadow. Just like with the hammer, it's okay to have a little bit of an upper shadow. This is perfectly fine as long as it's a small lower shadow. So there's a classic shooting star. If you're bearish here, I would have a protective stop above the highs over here. Now, okay, this is where we set the protective stop. Okay, question. What candle signal is this? Okay, you just type it in. Great, Chris. Oh, finally, an easy name to pronounce. Chris. Okay. Okay. Great. Now, the question is, all right, so Inet said, again, if I'm destroying your name, I apologize, says it's a buying opportunity. Okay, so what's your potential target if you buy? What do you think? And again, I should say candles don't give price targets, okay? But I think most of us would agree it would be up here, okay? And where's your protective stop? All right, the lower the hammer. Or actually, I would probably give it a little bit of leeway. I might give it to down over here. But if you're conservative, it would be the lower the hammer. Right, the shooting star would be my target. Okay? And look what happened. Okay, now, there's a great point. Chris is saying this is not confirming a support area. It might be. I'm not sure if this is a low here because I don't have the. If the market was moving down from here and it bounced from here, this hammer to me would be confirming support. But let's say we did buy in this hammer. Okay, this is why we have protective stops. If you were long here and you use the low of the hammer as your stop out area, you would have been out here on the, especially since it closed under support. And not every candlestick signal is going to work. The Japanese have a wonderful proverb. They say monkeys sometimes fall from trees. Okay? Not everything is going to work out. So having a protective stop is key. Risk avoidance is key. I know it's, you know, and the best time for me anyway to put in a protective stop is just when I do the trade. Because if we have a mental stop and the market breaks down over here, we're going to second guess ourselves and say, oh, the market's going to turn and move up. But this is a really important slide to reinforce the importance of protective stops. So the lower the hammer should be a stop out level, and the high of the shooting star should be a protective stop. Now, another way to do this is if you want a little bit more bullish confirmation, you could wait for a higher close. Let's say you don't buy on the hammer. You could wait for a higher close the next session to confirm the hammer. What's the downside with doing that? What if you wait for a higher close the next session? What does that mean about where you're buying it? Right, it means you're buying it at a higher price level. So if you're right, you're going to be making less profit, but you've lessened the risk of, or I should say you've increased the likelihood of the trade working out, because then you have bullish confirmation of the hammer. So there's no right or wrong answer to that. You know, some people would rather buy here, over here, and have that much profit potential if they're right. Other people would rather have a higher price to confirm the hammer as bullish. They would have less profit potential, but the odds of the trade working out are much higher. Okay, here's you were stopped out. Okay, and here's a cartoon. I knew we should have set protective stops. I actually found somebody who draws cartoons for me. He's very good. So I tell him what the concept they want, and he sends me a bunch of cartoons to pick from. So all the cartoons you see here are custom designed for candlecharts.com. Okay, and Cotillion had a good point there. Another way to do this, let's say on the hammer, you could wait for, let's say the market rallies, you could wait for a potential retracement to see if the low of the hammer holds support. All right. Of course, if the market does rally, it may not come back and retrace the lows over here. So lots of nuances. Obviously, we won't have time to get into all of them. Okay. Now here's a quote from one of the books I had translated. Combinations of bullish and bearish candle lines indicate the direction of the market, and investors, or traders, I should say, psychological conflicts at important turning points. So what the author of this Japanese book is saying is that we should not only look at individual candlestick lines, but we should look at combinations of candle lines. And the first of these would be a bullish engulfing pattern. Now notice here, I should say non-Forex bullish engulfing pattern. So let me go through that, and then I'll explain why I say non-Forex or FX. The market's in the downtrend. We have a white real body, and once again, when I say white real body, if your charting system is a green real body or purple real body instead of white, just mentally put that in instead of the white real body in your mind. A white real body that wraps around a black real body. And in equity markets or non-24-hour markets, the open really has to be below the prior close for this to be a valid bullish engulfing pattern. But because Forex essentially is 24 hours, it's perfectly acceptable for the open to be the same as the prior close. In fact, in our scanning software that picks out my favorite candlestick signals for Forex markets, this is how I define, or how the software defines, a bullish engulfing pattern. So even if the open and close are the same, or if the open is a couple of pips above the prior close, that is a valid bullish engulfing pattern in Forex. Okay, and as the Japanese would say, the implication is the market's bottoming out. And again, think of this, the bulls are taking over from the bears. And that is normally why in a bullish engulfing pattern, we want to see a small black real body to give us a sense that bears are losing steam. and a tall white wheel body, that means the bulls are really grabbing control of the market from the bears. Okay, so here you can see in MT4 we have the green wheel bodies, which is the same as white. This is a perfectly fine bullish engulfing pattern. And let me point out something, I'm glad I saw this here. Let me point out something interesting. Notice this white wheel body wrapping around the black wheel body. This white wheel body does not have to wrap around the shadows. It does not have to wrap around the lower shadow. All that need to happen is real body, wrap around real body. Everybody see that? So this is a valid bullish engulfing pattern. See this green wheel body wrapped around the red wheel body. Did this green wheel body wrap around the shadows, the lower shadow? No, right? But it did wrap around the red wheel body. And the same thing here. This green wheel body wrapped around, and see how the opening is the same as the prior close? That's perfectly acceptable in Forex. This green wheel body wrapped around the red wheel body, bullish engulfing pattern. Another bullish engulfing pattern. The point of this is not only is the market confirming a support area, but it's doing so with bullish engulfing pattern after bullish engulfing pattern after bullish engulfing pattern. See that? And in fact, one could have bought after this bullish engulfing pattern. Why could this be a potential buy with this bullish engulfing pattern? Normally, remember I said a candlestick signal by itself, I'd be a little cautious about. But what is this confirming? What is this bullish engulfing pattern confirming? What's happening over here? Right, it's confirming a support area. The low is over here. So let's imagine we don't know what happened over here. Okay, so here you have a bullish engulfing pattern confirming support. And if you needed more reinforcement over here and over here. All right. Now this is an important principle. A candlestick line or pattern requires two criteria. One is the shape of the line or the pattern. So we looked at the hammer, we looked at a bullish engulfing pattern. And two is the trend. Remember, we talked about, remember a hammer has to come after a downtrend. A shooting star has to come after an uptrend. Okay, a bullish engulfing pattern, the market has to come in a downtrend. That's what these down arrows are showing. So with this in mind, here's a green wrapping around a red. And notice I put not a bullish engulfing pattern. Why is that? Right, the trend is wrong. A bullish engulfing pattern has to come after a downtrend. This was during an uptrend or at best a lateral trading range. So this is not a bullish engulfing pattern. And I just want to lead very quickly into the importance of our software. And again, we're going to be raffling a few of them at the end of the session here. But it's called Nison Candle Highlighter. And it was designed for MT4, and this has 28 of my favorite candlestick signals. And one of the great things about NCH, that's how I abbreviate Nison Candle Highlighter, NCH, is you could pull up any chart on MT4 and it'll highlight all the candlestick signals. And the reason that's important is it will confirm whether a group of candle lines are indeed a candlestick signal. So notice this was not a bullish engulfing pattern, although it's a green wrapping around a black, right? And notice here are some candlestick signals with Nison Candle Highlighter. We have a tweezers top, a bear sash. We're not going to go through these. But the point is, within NCH, within Nison Candle Highlighter, this is not a bullish engulfing pattern. So for people who are would have thought this was a bullish engulfing pattern, by having the NCH running on your MT4, okay, you would know this is not a bullish engulfing pattern, and as such, you would know not to buy there. And look how much money you would have saved by knowing not to go long. Correct? And we'll look at a little bit more about NCH signals. Getting a lot of requests. I'll give you a link on how to find out about it and a special ebook we had prepared for you. Okay, now we looked at the bullish engulfing pattern. Now we're going to looking at the bearish side, the bearish engulfing pattern. Okay, non-Forex, a bearish engulfing pattern in the non-Forex market. The black real body wraps around the white real body. And in non-Forex, in stocks and so forth, in equities, the open has to be above the prior close for this to be a valid bearish engulfing pattern. In Forex, not surprisingly, it's okay for the open to be the same as the prior close. The market has to be in an uptrend. Remember, this is a bearish signal, so we need a trend to reverse. And the Japanese will say the bulls have been constrained. That is, the bulls have taken over from the bears. So let's look at this. This is a bearish engulfing pattern. Okay, red wrapping around the green. And a little bit of an uptrend, so that's valid. And notice again, this red real body, all it had to do is wrap around the green real body. The red real body did not have to wrap around the upper shadow. All that has to happen is real body wrap around real body. You see that? Okay, another little bearish engulfing pattern here. I just noticed a little bit of a rally, bearish engulfing pattern over here. And bearish engulfing patterns, like a lot of these candle signals, become resistance. So here we have a bearish engulfing pattern. Becomes resistance right around 127.20, right over here. This bearish engulfing pattern, you take the highest high of the two candles of the bearish engulfing pattern, becomes resistance, so the resistance level would be right over here, right around 127.85. Okay, why is this not a bearish engulfing pattern? Here we have a red wrapping around a green. Why is that not a bearish engulfing pattern? No trend, exactly, or a downtrend, right? Or you could view this as a little bit of a downtrend. Remember, a bearish engulfing pattern has to come after an uptrend, even a short-term uptrend. Now, notice this. Here we have a red real body that does not quite wrap around the green real body. It gets deeply into it. This is actually called a dark cloud cover, and we're going to look at that now. So the market opens, we have a rally, we have a white real body, the market opens at the prior close on this session here within a few pips, and notice this dashed line here, this dotted line. The close has to be more than halfway under the white real body. See, if this black real body wrapped around the white real body, that would be what? A bearish engulfing pattern. But if it gets more than halfway under the white real body, it's a dark cloud cover. And this is what this is, a dark cloud cover. And what's interesting is this dark cloud cover confirmed the resistance area set by this bearish engulfing pattern. Okay, so here we have a classic dark cloud cover. And you can use the high of the dark cloud cover as resistance. Okay, and so let me go back here. So the high here would be a resistance area, which was confirmed the next session. This one's interesting. Here we have a doji, right over here. Why would you not be too bearish on that doji? Remember the concept of candles in context? Where's the close of this doji? Right. It's right. It's closing. First of all, it's a higher high. We're still making higher highs and higher lows, and the close here is the same as the prior high close. You know, if the close was lower, then I'd be a little bit more nervous. All right. So something like this here. See, the close here is under the close here. This small real body I would view as a doji. It's a lower close. So I'd be more confident of a reversal. Here, we're still making higher highs, higher lows, and we're holding the high closes. So again, the idea of candles in context. You could have doji, but how you trade with the doji is going to be very different based on the overall market condition. Here we have a shooting star, dark cloud cover as resistance. And Gordon, we're going to give you a link. We're getting a lot of questions about NCH. We'll give you a link to find out more about it, as well as how to get a free ebook in a couple of minutes. So bear with us. And for those who are watching the video, you know, we'll have that in a couple of minutes. You know, you can watch the video. We'll be talking about that in about 5 minutes or so. Anyway, now this dark cloud cover is as resistance, but what is it also confirming? It's also confirming a resistance area. So this dark cloud cover might be a potential great short sale because it's confirming resistance. And of course, you would have the protective stop above the highs over here. Okay. And notice, here's NCH. This is, with NCH, you could have the candlestick signals abbreviated or spelled out. So here we had it spelled out. So I want to show you something interesting, and this is why I use NCH so much. Here you can see NCH shows a dark cloud cover. Notice something interesting. Why doesn't the NCH software show a dark cloud cover here on these two candles? Why not? Remember, one of the rules is exactly, it's the real body is too short. It's not more than halfway in the green real body. And the reason I love using NCH, even though I know candles inside out, is because before I developed the Nison candle highlighter, I had to figure out what the middle of the white real body was. See, here, visually, could you tell if it's below the middle of the white real body? It's really close. So I had to figure out what the difference between the opening and the closing was, and what the middle was, and if the closing was under the middle. Now all I do is pull up a chart in NCH, and you'll see this is a valid dark cloud cover because it's under the middle, and this one isn't. So it saves me tons of time on trying to figure out if something is a dark cloud cover or not. Now, the opposite of the dark cloud cover is the piercing pattern. The market is moving down or moving south, and then we have a white real body that gets more than halfway into the black real body. Okay, a piercing pattern or a piercing line, however you want to phrase it. And again, if the white real body was bigger and wrapped around the black real body, what would it be? A bullish engulfing pattern, right? So, but if it gets more than halfway into the white real body, the bulls have intruded deeply into the bear's territory, and the Japanese will say that it's a hint that the decline is exhausting itself. So here we have some signals with NCH. Okay, we have a bearish engulfing pattern, we have a dark cloud cover, and a piercing pattern. And the reason I wanted to show you this is because notice the dark cloud cover, it's the piercing pattern and the dark cloud cover are the opposite. Okay, so if you, let's say you sold in this dark cloud cover over here and you had a protective stop here, the first sign of the market bottoming out via candlestick signals was this piercing pattern. So if you sold here, you could have taken profits over here. On the flip side, if you bought here, I probably would not, because this pierce pattern is not confirming support. But let's say you look at Fibonacci retracements, and let's imagine, going back, let's imagine we had a big rally and you have a 50 or, 38 or 61% or 62% retracement, and you have a piercing pattern confirming a retracement level. That might be a reason for you to buy because you like using Fibonacci. So if you bought on the piercing pattern, my target would probably be anywhere around here, the high of the dark cloud cover. So I might have taken profits a couple of, let me see, this is a couple of sessions later. Okay, so sell here, and you could take profits there. Okay, candles as support. So here we have a piercing pattern as support. And I would also take the low here. So let's say we buy here. And I would view this as a hammer. The upper shadow, yes, is a bit of an upper shadow, but it looks like 10% or less than the lower shadow. I would have NCH on to see if it's a hammer or not, but it doesn't matter. The point is, you wouldn't even have to wait for the close of the session here. You get to think about buying when the market gets here. A lot of nuances, don't have time to get through, but one of the downsides of candlesticks is that you have to wait for a close. So by the time you got the signal, it would be over here. But one of the things you can do, if during the session here, this is a daily chart, during this time here, during the day, if the market gets anywhere near here, you could be buying it here, and you could have a protective stop here. So what that's letting you doing is you're buying it here. You have a less risk because you're buying it here, and your stop is here. Nothing wrong with buying it here, but now your risk is all the way down here. But here you have the main thing is you could use a lot of these candlestick signals as support or resistance. So the piercing pattern as support and the low here, and my target would just be the recent high. Your target might be something completely different. I like looking at prior highs and prior lows, so this would be my target, and I'd be taking profits either here or on this shooting star. Okay, you may want to lock in profits here. Why would you be a little nervous here? What candlestick signal is this? It's not quite a bearish engulfing pattern. What is this? Remember when the black, right, good call on that, Sanchi. Right, Cataline, and many others who I'm not even going to try to pronounce your names. Dark cloud cover, exactly. So nothing wrong with taking profits there. Now, the Japanese have a wonderful proverb. They say, without practice, knowledge without practice makes but half an artist. So what I've done is, I'm just laughing at a comment somebody made. What I've done is I've made a chart challenge. So what you're going to do is name the candlestick signals at 1, 2, 3, and 4. And for those of you who are watching this on a video, just put the player on pause and think about the answers, and then you will hear the answers. So what's number 2? And actually, this is a chart we saw before, but now we're kind of to reinforce what we learned and to kind of cement into your memory some of the patterns we talked about. Okay, number 2. Cataline, right? Kevin, great. 2 is a dark Brian. Right, 2 is a dark cloud cover. Great. Okay, number 1. And it's a little bit of a lower shadow, and it's a white green candle, but it doesn't matter. Right, great. Good call on that. Shooting star. Number 3. Okay, with a green body, and it does get more than halfway into the red body. Piercing. And number 4, it's a black real body wrapping around a green real body. Okay, Marco got it correct. So we're looking at number 4 now. The red wrapping around the black. And many of you are saying a bearish to new, right. It's not a bearish engulfing pattern. And somebody got it right. The names are going by so quickly. Correct. It's not a pattern. It's not a signal. Because remember, for a bearish engulfing pattern, for the red to wrap around the green, that's part of it. What else does it have to be? What kind of trend has to be before a bearish engulfing pattern? Remember, it's a bearish reversal, an uptrend. Exactly. And so let me show you the answers based on NCH, Nison candle highlighted. These are the signals with abbreviations. So you can see DC is a dark cloud cover. S is a shooting star. P is a piercing pattern. And notice there's nothing here. It doesn't say bearish engulfing pattern. Why? Because the trend is wrong. And what we do with NCH, Nison candle highlighter, is we take into account trend. Okay, so that's why this is not a piercing, a bearish engulfing pattern. So I'm getting a lot of questions. Let me give you a link here to go, and these 1, 2, 3, and 4. Okay, so for those of you, and we're going to be doing more, but I wanted to throw this in now because we're getting a lot of questions about NCS. So for those who want to find out more about how within seconds you could pull up any chart in MT4 and find my favorite candlestick signals, and we're going to give you a free report also. You go to the special link. We set up, you know, as a special thank you working with Admiral, candlecharts.com/special/Admiral. And what you're going to do is see this, and don't do it now, you know, because we still have a lot of education to go through. You'll do it a little bit later after. But what you're going to do is when you go to this link, you're going to see this pop up. And what you need to do is put in your email address. We need a valid email address because what we're going to be doing is sending you information about the Nison candle highlighter. We have special pricing and also some really cool special bonuses available only to you. Plus, we're going to be sending you a free ebook, The 3 Common and Costly Mistakes Almost Every Trader Makes with Candle Charts and How to Correct Them Instantly. And we're getting a lot of comments. Super nice. Thanks. Yeah, it's really my pleasure. And it's kind of a thank you for Admiral inviting me to speak with you. So all you do is enter your email address. You don't even have to give us your last name. Give us your first name, and we'll send you information about NCH, Nison Candle Highlighter, special pricing, some cool bonuses, plus this ebook available to you instantly. So, and again, it's my pleasure getting another thank you. So now we talked about candlestick charting. We touched a little bit about Western technicals, but now I want to talk a little bit more about candles and Western technicals, the second leg of our trading triad. So here we got a nice quote from one of our students in Germany. Proper identification of support and resistance areas together with price and candle pattern analysis is the first and most important step towards successful trading. And I totally agree with that. So let me show you one of my favorite Western strategies in combination with candlesticks. Now, I had mentioned that I like just using prior support and resistance. And indeed, I do. But let me show you one of the patterns I like working at with candles. The Japanese, as I think I mentioned in one of the other charts, a lateral trading environment or a trading zone. The Japanese call it a box range. So that's where resistance is tested twice and support is tested twice. So when the market fails from the top end of a box range, what's great, especially with a candlestick signal, what's really good about that is we get a target. Where's the target? The recent low, the bottom end of the box range. Same thing here. If we're in a box range, remember it has to be tested twice here and at least twice here. If the market has, say, a hammer or a bullish engulfing pattern, or one of the other patterns in NCH, like a bullish Hadermi or, you know, a piercing pattern, we could think about buying it, of course, with a protective stop, and our target is the recent high. So here, for example, nice box range. Okay. So here the market successfully tested the bottom end of the box range, and here it stalled. Where did it stall here? With a shooting star and a bearish engulfing pattern, right? So the target is the bottom end of the box range. Everybody see that? Here we have a failure resistance, and my target would be over here. We might have a little minor support here, but this support is my target. Now, one of the other great things you can do with a box range is once the market breaks out of a box range, you could take the height of the range, and actually let me just draw this in now because I'll show you. Whoops. Okay, so let's say here's the box range. And once the market breaks out of the box range, you could take the height of the box range and add it to the breakout. So that would give you your upside target. All right, everybody see that? It's a measuring target. And the opposite would be if the market, let's say we're in a box range here, and say, you know, the market, it should be support. But if the market closes under the bottom end of the box range, you then have a downside target. You take the height of the box range. This is one of my favorite measuring targets. And the reason I wanted to show you that is because on the next slide here, notice what happened. The market closed under the bottom end of the box range. So what I did, and I'm not, I did this a little while ago, so I'm not sure if we reached the target or not, but I took the height of the box range and subtracted it from the bottom of the box range, and this becomes my target. So if it broke on the top, above the top end of the box range, if it broke above the top end of the box range, I would do the opposite. I would take the height of the box range and add it to the breakout. Okay, and somebody saying, but previously we had a hammer, right? And that is, let me go back here. That's true. By the way, this is not a hammer. The upper shadow is too long. But if this was a hammer over here, as soon as the market closed into the low of the hammer, you should be out of long positions. But this is not a hammer. NCH would not be picking this up as a hammer because the upper shadow is too long. Now, another reason I like horizontal is because if we have a multi-tested support area, and what I mean by multi-tested, it has to be tested at least 2 times. We know the support, hopefully, if you're bullish, should hold. If the market breaks under that support, okay, let's say you bought at support, let's say you bought here, you're thrilled because the market tested it many times, you congratulate yourself because you bought at a support area, then the market does this. Okay, congratulations, you bought at support. Would you still be happy you bought up here? You probably feel like this, right? The market breaks support, you're long under a broken support area, and you're just hoping and praying that the market comes back up for you to get out at break even. So based on that, it is one of my favorite trading strategies to find support or resistance, is what I call change of polarity. And this is a very common Western signal. But I just came up with the term change of polarity. Once old support is broken, that old support becomes resistance. And think about, this technical analysis, whether it's candlestick charts or even bar charts, have valid psychological reasons why they work. And here's a case in point. Anybody who bought here or here or here or here, once they buy here, are now losing money. Wouldn't you and they be thrilled to get out at break even if the market came back, right? So all the buyers here become what here? Sellers, exactly. All right. And same thing here. Once the market breaks out, the old resistance area, if the market is good, should become a support area. And this is how I trade momentum. If the market breaks above a resistance area, if I buy on a breakout, my protective stop is under the prior resistance. If I do a bearish trade, if the market breaks under support, my protective stop is under the prior support area. Because if the market is weak, once the market breaks support, it should not get back above the broken support area. If the market breaks above resistance, it's up to the bulls to keep the market above that resistance area. If they fail to keep above the resistance area and it pulls back here, that's a false breakout, and oftentimes that could be very, very bearish. Okay, so change of polarity, one of my favorite ways to define key support or resistance. So here, okay, recently in the US Canadian resistance area, bearish engulfing pattern is a classic bearish engulfing pattern because the market was in an uptrend. Resistance, see, it has to be tested, the resistance has to be tested a few times. Resistance, resistance, resistance. Once the market closes above that, one could think about buying it with the idea that the prior resistance should be the new support. And now that I see this, let me show you something here. this a little thicker. Okay, let me go back to the full screen. Now what do we have here? Here and here. What's here? What were we talking about? One of my favorite trading strategies? Right, a boxed range. So now the market broke above it, how do you get a target? You go from the low of the box range here, let's say over here, to the high over here. So you take this distance, whatever it is, 130, it's hard to see, 132.30 I think, 135, looks like a couple hundred pips, but whatever the distance is here, from here to here, and you add it to the breakout to get an upside target. Now it doesn't mean there's not going to be any resistance. You know, let's say we had resistance over here. Let's imagine, you know, I don't have the charts going back here. It doesn't mean you don't take profits there, but this gives you a price target, box ranges. And so once he broke above the resistance, the old resistance became new support. And on the flip side, if the market broke under the support area, what should become new resistance? Right, the old support. Okay. Change of polarity. Again, recently, this is actually a weekly chart. It was an important breakout in the pound dollar. This resistance area, it's a little hard to see here, but these two blue lines, major breakout here. And for those who follow the pound dollar, it's very important, especially on a weekly close, to hold above this change of polarity. Because now the market's broken out of this long-term resistance area, this old resistance must hold as new support. Okay, let's do another chart challenge. Keep you awake. Okay, number one, is this a bullish engulfing pattern? It's a green, and I don't have Nison candle highlighter on here, so green wrapping around the black. Great, you're all getting, but good, good. Well, it's a real compliment to you that you're picking this up so quickly. Everybody is saying no. That's great. Yeah, because we need trend. Remember, it has to be a downtrend. Like this would be a bullish engulfing pattern here. Why? What was the immediately preceding trend from this dark cloud cover? Down, right? Over here. And another little clue, the bears were losing steam here, not only the small real body, but the long upper and lower shadow. Remember we talked about the high wave candle showing the market's confused? Was it confused going down? No. So here is a sense of confusion. The trend has turned from down to neutral, and this turns it short-term bullish with the bullish engulfing pattern. Okay, now the question is, what are 3 reasons to be selling here? Okay, the bearish engulfing pattern, correct. Okay, it's a red wrapping around the green. I'm really impressed most of you got this because, you know, many times we'll forget about this. We're so focused on candles. But yeah, you're all getting it. It's confirming a resistance area. Great call on that. That's really, really important. And of course, the third reason is a shooting star. But to me, a key factor, a major factor, yes, beside the multiple candlestick signals, which are great, and actually this bearish engulfing pattern is confirming the shooting star's resistance, so that in itself is great. But look at all the resistance going back. And this brings out an important point. Not only, you know, look at what's happening with the candle signals, but look at what happened, you know, prior to these candlestick signals. Are you near a major resistance or support area? So great call on that one. And now we'll look at the third leg, vitally important. Once again, I could spend hours on trade management, just as I could spend many more hours on Western technicals and candles. But my goal here is to kind of give you a snapshot with some advanced strategies on how to correctly use candlesticks. And a key aspect many traders do not take into account is trade management. And the most important rule, and I think in the announcement that Admiral had on their website is, you know, Steve's most important trading rule. This is it. You ready? Okay, with that, I'll see you next week. All right. In fact, when I used to do my live seminars, I used to say, this is my most important trading rule, and start walking out of the room. Okay, so it is, okay, risk reward. Okay. Okay. A candlestick signal or a candle signal, even if it confirms other indicators, is not enough of a reason for a trade. You must always consider the risk reward. So in other words, if you have a hammer, or here, let's go back here, multiple bearish candlestick signals, okay? Shooting star, bearish engulfing pattern, confirming resistance. Another thing you have to take into mind is you have to think about the risk reward. And we know the reward part is your potential profit, okay? What is your target? You know, and your target might be different than mine. Candlesticks, yes, they can give you times to enter or to exit a trade, but before you put the trade on, you have to think of what a potential target is. To me, I look for the nearby resistance. And as Sanchi says, yeah, I normally look for 1 to 2 risk, reward risk. And risk is what your potential loss is. All right, so we know what risk reward is. So let's look at this. Which is the better short trade, 1 or 2, and why? And these are both dark cloud covers. And we'll let the chart will take a minute or two to come up. There we go. And by the way, look, what do we have over here? A doji. And notice how the doji became resistance right over here. But anyway, so think about this. Dark cloud cover 1 and 2. And remember what we were just talking about, risk reward. And as Levente says, depends on your target. Right. So what do you think would be a very reasonable target with dark cloud cover 1? And can you read the numbers? What do you think would be a reasonable target? Let's say we have a dark cloud cover here. Would this be a reasonable target? Yeah, I think so. All right. So that should give you a hint of what the correct answer is. Okay, so let's make that our target. And let's think about the risk reward. All right. Okay, so if we shorted on this dark cloud cover, that is our stop out level. Okay, everybody agree with that? And our target would be here. So that's less than a 1 to 2 risk reward, right? I mean, it looks like to me, you're risking more than your potential target is. So this is a trade I would potentially stay away from. Whereas a dark cloud cover here, this is your risk level, your stop, correct? And this is your target. Does that look like a good trade? Yeah, I think so. And this is a great example of how you could have the exact same candlestick signal, in this case, dark cloud covers, and you would trade completely different on them. And this is what our education is all about. It's not just learning about the candlestick signals, it's, you know, what to do with them. So by getting this education, you're going to be so many light years ahead of other traders to know how to use the Nison candle highlighter. Because, again, I don't have Nison candle highlighter on here, but these would be both picked up as dark cloud covers. But now with this education, with this idea of risk reward, you would know, hey, NCH picked up a dark cloud cover. I think this looks like a good short sale. It's confirming resistance, and there's a good risk reward. Here, yes, the dark cloud cover is confirming resistance at the doji, but it's not a good risk reward. So this is something to take a trade on and something not to take a trade on. And let me ask you something else here, okay? Here we have a doji. Now, let's think about risk reward. Would you think about shorting on this doji? Okay, what would your target be? I know what my target would be. I think, you know, I'm thinking down here, right? The recent low. Once again, you may have another target. So yeah, I would think my target would be down here. So my target if I short it here, is my profit potential is over here. So you're going to have to mentally draw in a line, right, over here. And actually, just to make it a little easier, I may as well do it with the magic of PowerPoint. And, you know, many, many, many years ago, before many of you were even traders, I used to use overhead projectors. I used to use transparencies. And the problem with that is, you know, once you make the transparency, you can't change it. So this is the profit potential. And let me just make it a little thicker. Okay, everybody see that? To, you know, over here. And what's your stop out level? My stop out would be over here. Does that look like a good risk reward? You sell it here, your target is here, and your stop is here. Yeah, super, yeah. As Bonadici is saying, it's super risk reward. Yeah, it's great. I might not be too aggressive on it because the doji is not confirming resistance. You know, if it was confirming resistance, I'd be very aggressive on it. But this brings out the core concept of risk reward. So let me just wrap it up here. I'll take a, you know, couple of questions from you, and we're going to do a raffle. But let me do another chart challenge, and then let me give you the information about Nison candle highlighter again, because a lot of questions. Okay, so what bullish candlestick signal is this? Question number one. Based on this signal, would you buy, why, or why not? And most of you are getting this correct. It's a hammer. Would you buy, why, or why not? And this is a little bit more advanced because we talked about, you know, one of the key points, remember old support? Right, exactly. It broke a support area. Right. Great, you're all getting it. Super. Boy, I just want to compliment Admiral for having such astute students. I'm really impressed. Exactly, it broke a prior support area. So, and these are, so close over resistance. So, and here, look at close over resistance. Do you buy? So in other words, it's a bullish breakout over here. Do you buy? So we have the resistance at the doji. It closed above it. Okay, do you buy? And then we'll look at the answers. And the answer is no. Why not? If you close above the resistance, isn't it close above resistance? Right, exactly. So the answer is, look at this, where this resistance is over here. So if you buy here, right, and your target is up here, and the stop out level, I'm not sure where the stop would be. I'd probably make it over here. It's not a good risk reward. So yes, you could break resistance above the doji, but you have to look at the prior resistance to see if it's a good risk reward. And you all got it correct. Change of polarity. Prior support, once broken, which this hammer did, becomes resistance. So if you buy this hammer, you are actually buying at a resistance area. Right? When would you think about buying on this hammer? What would have to happen? The next session, or 2 sessions after. What would give you bullish confirmation of the hammer? That's a potential buying signal. Not necessarily a bullish, no, it doesn't have to be, yeah, bullish candle, but what has to happen? What kind of price do we have to see? Right, Brian, exactly. We have to see a close above this broken support area. Remember, prior support becomes resistance. So in this case, we'd have to see a close. This would be safe, let's say above 108. 108.7, 108.470. We'd have to see a close above here because that would mean that market broke a support area. So good call on that. So, you know, I hope these chart challenges really got your brains working and helped cement and, you know, what we learned. And let me give you this information again. Go to this link. Don't do it now. We're going to be doing a raffle, and I'll stay around a couple of minutes for some questions. You can go to this link, candlecharts.com/special/admiral. You'll get a free report, and we're only going to have this on for a few days, by the way. Okay, we're going to be taking this down in a few days. There's some really cool bonuses. You'll be getting a video of all the candlestick signals and NCH. You'll be getting how I set up my trade using NCH and so forth. And you'll also be getting this ebook, The 3 Common and Costly Mistakes Almost Every Trader Makes with Candles. That's available to you to instantly download. And make sure you put the email address in correctly, because that is where all this information, including the free ebook, will be coming. So with that, I'm going to turn it over to do a raffle. Then I'll be glad to spend, well, timing is perfect, exactly an hour and a half. I'll turn it over to the raffle, and then I'll stay around for a few minutes to answer some of your questions.
Excellent. Thank you, Steve. Great webinar. Really great session. Always good to learn something new. So now I will share a screen, and we can actually start a raffle. But before we start, I just want to introduce you to our live webinar. So guys, feel free to come. A Wednesday live trading session recap, also with me and Chris. We are doing live trading on real accounts and always show you pre-fact and post-fact results. Setups are live, and we use a lot of tools to guide you to your Forex success. Of course, being also familiar with Steve Nison teaching, we use a lot of his candlesticks that are proven to work for more than 30 years. Okay, so now we will start a raffle. So the first three who actually appear here, you see this is a randomizer. We don't know who will win the award. But the thing is, when I click randomize, all of these emails that you submitted will be eligible for a reward. But the first three will get a month of subscription to Steve Nison's Candlestick indicator. You will need to send an email to him, and you will be you're receiving your award. But before you do that, let's start with raffle. Okay, I will click randomize now. Okay, randomize, and this is it. The first three are here. Okay, so the eligible for a reward. Okay, so guys, you can see now from my screen, you will recognize your email. Okay, and now I will share the screen with Steve. I will give him the presentation, and I wish you a trading success as always, guys. Cheers and trade safe. Steve, you can continue.
Great, thanks. Let me just get this over here. Okay, so let me answer any questions you may have. Let me just make this full screen. Oops. Oh, you gave it back to me. Okay, let me do screen 2. There we go. Okay, question number 1. How do you determine longer term? Okay, candles working all. Okay, let me. Do candles work in all time frames? Yes. Can they be used in binary options? As long as you have I'm not that familiar with binary options, but as long as you have an open, high, low, and close, and if so, the answer is yes. With my option trading, I always do regular options, but I'll base my trades on the underlying security. I'll do the candle analysis on the underlying security. I won't do it on an option chart. Okay, would you say yes? And it was okay, and we're not going over specific markets. I'm getting questions about specific markets. How do you determine longer-term trend? Okay, what I personally do is I look at 2 moving averages, a 20-day moving average and a 50-day moving average. They're both simple moving averages, and if the 20 is above the 50-day moving average, the longer-term trend to me is up. It's better if both slopes are up. It's the 20-day moving average and the 50-day moving average are both sloping up, so that to me is a longer-term trend. And the advantage of knowing the longer-term trend is because when I set my price targets, if I'm going, in other words, say I have a bullish candlestick signal confirming support and I have a good risk reward, if I'm in the direction of the longer term trend, if the longer term trend is up and I'm doing a bullish signal, I'll look for a higher profit potential. Whereas if I'm doing a bullish candlestick trade in a longer term bear market, I still might do the trade, but my profit potential, I'll be looking for less of a rally because the trend is kind of going against the short-term trade. Okay, how do you deal? Let me see. Oh boy, sorry. How do you deal with the psychology of the market? Well, first of all, the candles give you the psychology of the markets, and market makers go after stops. They do not. It's not. I used to give seminars for market makers years ago. NASDAQ, NYSE market makers, That is not true. What you have in the market is so minuscule compared to what they see. They're not going to go after your stops. Don't worry about that. Don't, you know, don't worry about that. Let's see what else here. Okay, does lifetime include upgrades to software? Yeah, NCH is lifetime. Normally we do only 1 year, but we're making this lifetime as a thank you for attending and watching this. But we're making this lifetime. You'll see when you go to the link, and that includes any upgrades to the software forever. Okay, in your opinion, is it better to use Japanese on the Forex or the stock market? The answer is yes. I use it in all the markets. Now, there are some nuances. So, for example, when you're looking at intraday and equities, I don't want to spend much time on it because I know most of you are Forex focused. But like a lot of equity markets, if you look at very short time frames, there are so many doji that I don't really pay attention to doji in intraday and Forex. I'm sorry, in intraday on equities. But what's nice about Forex, the markets are just so liquid, especially on the major crosses or pairs, that you know, you could use intraday just the same way as you would as a daily. My time frame, I use a daily chart, my favorite time frame, and the only reason for that is because I'm running a company. So what I have to do is actually set up the potential trade for the next day's session the prior night. What I'll do is I'll actually use NCH to scan through the markets and find candlestick signals, and then I'll put my favorite Western technical signals on the chart and determine, you know, which trades I take or not. Because remember, NCH doesn't give you a buy or sell. It'll give you a candlestick signal. Then you use your education that you got here to determine if you're going to use it to buy or sell. So when you get a candlestick signal, let's say you get a hammer, does it confirm a support area? And if it does, is it a good risk reward? Then you can think about doing the trade. Or if NCH picks up a bearish engulfing pattern, is it confirming a resistance area? Whether that resistance is, you know, based on a Fibonacci or a prior high or a trend line. If it does, that's a potential trade setup, and then you have to look at the risk reward to see if it's a good trade. But that's the first thing I do. Okay, what's your favorite financial instrument to trade, and what strategy do you use? Okay, one of the things I'll look at, like I mentioned, is I trade mainly equities. The Forex, because to tell you the truth, I don't like being up in the middle of the night and have to worry about the markets. I will set protective stops, but I'll look at, you know, mainly equities. And my strategy, just very simply, again, you know, just a very simple idea. Is there a valid candlestick signal? Is it confirming one of my Western signals? And is it a good risk reward? Okay, and that's essentially it. Now, my favorite Western signals may be different than yours. All right, I don't look at Fibonacci only because, you know, I just really never got involved with it. I know Fibonacci is very important in Forex. I personally, you know, like looking at prior highs and prior lows. All right, so we're getting a question about windows. I didn't talk about it because windows are very rare in Forex. The only time you really get a window is between, you know, when the markets are closed over the weekend. But a window is the same as a gap, and a gap can be a support or resistance area. I use windows all the time in non-Forex. But if you do get a gap in Forex, it could be a rising window or rising gap should be a support area, and a falling window should be a resistance area. And of course, yeah, as mentioned, Cataline mentioned, sometimes you get it on news. And speaking of news, you know, at times you could have the perfect candle signal confirming a support area and a great risk reward, and surprise news comes out. And it could either help you or hurt you. You know, there are things that technicals do not forecast, and surprise news is one of them. And personally, speaking of news, I do not do a trade if I know an important news item is coming out. If I know, you know, an unemployment report is coming out in the States here, or something that'll have an impact on the Forex market or any market, I'll wait to see how the market reacts before I do a trade, because you can be completely correct on your outlook for the fundamentals, right? Let's say you think, oh, a bullish unemployment report comes out, And it is, it should be a bullish report. It comes out good news, but the market doesn't rally. What is that telling you? If it's not going up on good news, what's going to happen on bad news? So to me, it's not the news itself, but it's the market's reaction to the news that I find really, really important. Okay, and NCH works in all time frames. I'm getting some questions. Okay, so it looks like we answered all the questions. Thank you so much again. I want to thank Admiral for inviting me to speak to the very intelligent and enlightened group based on the answers you gave me on the chart quiz, on the quizzes. And, take advantage of the free information we're giving you, and the NCH is a great vehicle. I use it all the time. And so thanks for joining me, and may the candles continue your light to profitable trading.
Thanks again, guys. I expect to see you soon. Cheers, Steve, and everyone. Have a great day. Have a great night wherever you live, and talk to you soon. Cheers. Trade safe.
Thanks. Okay, thanks.